I'm here with David Neithercut, President and CEO of Equity Residential. David, despite the challenges in the market, Equity Residential beat expectations in its most recent financial results. What do you attribute the company's success to?
Well, we don't measure success in 90-day increments, but I will tell you that we started 2009 very similarly to the way we started 2008, and that was with a real focus on operations and running our properties as best as we possibly could. We realized it was going to be a challenging several-year period, and the troops were really focused. We've primarily exceeded even our own expectations for the last quarter, primarily because of cost containment. We've really done a great job with expenses on our site, thanks to a lot of really hard-working people across the country. Driving down leasing and advertising costs, reducing our turn costs, and really taking advantage of a tough economy, renegotiating every single contract that we've got out there, just making sure we're running our properties as tight as possible.
How do you expect the major macroeconomic factors affecting your company to play out in 2010?
Well, clearly a challenging economy will be a issue for us in 2010, just like it was in 2009. We need jobs. Job growth really is the mother's milk of our business, is the gas of our engine. And we've had a significant amount of job loss. Hopefully we're going to see an end to that job loss, and I think that if we can just get to a point where our existing residents and our existing prospects aren't worried about losing their jobs, I think we're going to be able to turn the corner. Certainly we need job growth to really move rents in any material way, but I really am hopeful and expect in 2010 we'll see a stop of job loss, and I think as a result of that you're going to see the tide begin to turn for the multifamily space.
And what steps has Equity Residential taken to stabilize its balance sheet?
Well, starting in 2008, we were very thoughtful about our liquidity, concerns about the senior unsecured market, and fortunately in the multifamily space we had access to Fannie and Freddie. So in 2008 and 2009, we set about a plan to shore up our balance sheet and extend the duration of our debt. We borrowed a lot of money from Freddie and Fannie at very attractive rates. We bought in some of our convertible bonds that mature in several years. We did tenders for our own debt, and it put ourselves in a great position today. So we have just under $900 million of cash on our balance sheet. We have less than $150 million of debt maturing, the balance of 2009 and 2010. So we are in great financial condition.
Great. So it sounds like you're very satisfied with the balance sheet. Is there more to go in 2010? Do you foresee needing to issue more equity or anything along those lines?
No, we were one of the firms that did not take advantage of the sort of re-equitization opportunity. We felt that we had sufficient liquidity to weather that storm. And everything we've done really up to this point in time has been more defensive focused, and I think that if you see us do anything going forward, it's because we believe the opportunity presents itself to become more offensively minded.
That leads into my next question. When do you see some of these offensive opportunities, acquisitions, shaping up, and is that something you have your eye on right now?
Well, it is, but I'm telling you, we're not quite seeing anything close to the opportunities that one would have expected us to see. We have bought our first deal in almost 2 years. Last week we closed on a really terrific asset in the Pentagon Row area of Arlington, Virginia, an absolute Class A asset that we were able to buy. We thought a very nice discount to replacement cost, and certainly a very significant discount to where that asset might have traded in a high watermark several years ago. We are seeing more product. We are underwriting more product. But we don't believe that we're quite seeing the amount of supply that we might see in 2010 should banks and other lenders begin to offer product in the marketplace.
David, thank you very much.
My pleasure.
For REIT.com, I'm Matt Bichardt.